Hello and welcome. Yesterday, the European currency continued to gain value against the US dollar. However, I expected the pair's upside momentum to fizzle out. The euro was supported by strong data on inflation in the euro area. According to the final estimates from Eurostat, annual inflation came in at 8.6% last month, up from 8.1% in May and in line with consensus. Compared to the previous month, consumer prices were up to 0.8%. All these is expected to force the European Central Bank to act more aggressively to combat surging inflation. Against this background, demand for risky assets is growing. Moreover, a correction in the euro has been long overdue. Now, bulls are aiming at the new resistance level of 1.0265. As for the British pound, it also rebounded to the area of 1.2030. Yesterday's data on the UK labour market turned out to be a mixed blessing. On the one hand, the job reported was disappointing. On the other hand, statistics indicated the strength of Britain's labour market in the current economic situation. Amid high inflation, UK unemployment even fell, jobless claims declined, and the number of job vacancies rose. A slowdown in wage growth may somewhat reduce inflationary pressure. However, the British government plans to offer millions of public sector workers pay rises averaging 5%, which may lead to a continued rise in consumer prices. In this case, the Bank of England will also be forced to take more aggressive steps in its fight against soaring inflation. Today's macroeconomic calendar includes data on UK consumer prices. The annual consumer price index is expected to jump from 9.1% to a new record of 9.3%. On a monthly basis, consumer prices are anticipated to climb by 0.7%. Well, we'll see. Obviously, inflation will keep on accelerating. If the indicator surges to 9.6% year on year, the British pound will most likely advance amid expectations of further interest rate hikes by the Bank of England. However, a cost of living crisis in Britain will probably curb investor appetite, thus preventing the pound sterling from gaining strong upside momentum in the near future. In addition, traders may take notice of Germany's producer prices and a speech by a representative of the country's central bank. In the second half of the day, it's worth paying attention to the statistics on existing home sales and crude oil inventories in the United States. However, these reports will hardly have a severe impact on the currency market. Now, let's take a look at the 1-hour trading chart and consider the euro-dollar pair from a technical point of view. A false breakout at 1.0265 will create a sell signal. In this case, the euro will slide to 1.0208. If the price fixes below this level, it will most likely head for 1.0168 and 1.0127. At the level of 1.0127, it will be possible to go long on a rebound. At the marks of 1.0168 or 1.0208, long positions can be considered only amid a false breakout. Alternatively, if the euro breaks through 1.0265, consolidates above this level and tested from the top down, the volume of long positions will increase. Thus, the pair will have a chance of rising to 1.0321 and 1.0374. At the level of 1.0374, I recommend going short on a rebound. Short positions at 1.0321 will be relevant in the event of a false breakout. Speaking of the British pound, it continues to trade upwards. Today, bulls will probably make every effort to push the price above yesterday's high. If the price overcomes and consolidates above 1.2040 amid upbeat data on the UK economy, a buy signal will come. In this case, the pound sterling is expected to advance to 1.2081 and 1.2119. At the level of 1.2119, traders may go short on the rebound. Short positions at 1.2081 or 1.2040 can be opened only in the event of a false breakout. If the price goes down following downbeat UK statistics, a false breakout at 1.2002 will create a buy signal. However, if the pound sterling fails to rebound from this mark, it will be a wise decision to put off going long until the price reaches 1.1965 and 1.1925. At the level of 1.1925, it will be possible to buy the pair on a rebound. Long positions at 1.1965 can be considered only amid a false breakout. In case bears are able to regain control of 1.2002, the pound-dollar pair will get stuck in a wide sideways range of 1.1925 and 1.2040, with the level of 1.1965 acting as a middle line. Most likely, sellers will aim at the 1.1925 mark, where I will try to buy the pair on the rebound with a view to catching an intraday correction of 30-35 pips. Good luck.